All right. Hi, everyone. Thank you so much for joining. We're very excited to kick off this four-part angel investing series. Very grateful for Dima Shahin, our London City chapter lead, for kicking us off today, this session, and also our second session. Make sure you check our calendar of events. You'll find it on our website and sign up for the other sessions if you have not. Yeah, Dima, if you can move to the next slide, please. So, we want to start off by thanking our sponsors, Taft. So we want to start by thanking Taft. This series is proudly sponsored by Taft Law, which is a leading law firm and with deep expertise in supporting startups, venture funds, and high growth tech. I want to tell you a little bit about Viaka before we get started. So, if we can go to the next slide, Dima. So, we are a global platform. We scout, invest in, and support the growth of exceptional MENA connected and diaspora founders, while at the same time bringing together and convening a trusted network of founders, investors, and operators who are mainly located across North America and London. Now, at the core of Viaka is our angel network, which is a growing group of 80 plus active angel investors who co-invest in early stage, high quality startups that are sourced through our city chapters, events, and our extended scout network. And since we launched last year in March 2025, the network has invested in 10 companies with one follow on, and we've deployed over $600,000 alongside leading US investors such as YC and Sequoia. Our investment activity is supported by a very strong sourcing engine. It leverages our wider global 4,000 member group and through also our five active city chapters in New York, San Francisco, Boston, Toronto, and London. And one of the things we've done intentionally is make angel investing more accessible. So our members can participate with checks starting at $1,000 with no obligation to invest, which allows them to learn, build exposure, and invest alongside very experienced angels in a very structured way. We also at Viaka highly welcome young professionals who want to join the network and experiment with angel investing. Please reach out to me. I will share my email in the chat. Reach out to me after the session for more information. Now, beyond capital, we spend a lot of time helping founders actually grow, and this includes go to market support, introductions to investors and partners, and also important convenings like MENA Rising, which is our annual flagship event, which we hold in New York and Toronto, where we bring together founders, investors, and operators in a highly curated setting. Check our calendar of events for the dates for both MENA Rising New York and MENA Rising Toronto. Now, for our investment profile, we back exceptional early stage founders with very strong execution ability. We invest between 25 to 200K per company. And we partner early, so we build long-term relationships with those founders. We place very strong emphasis on co-investor alignment, where we invest alongside very reputable investors. We are sector agnostic, but we invest, of course, in VC-backed tech-enabled startups that have the potential to scale globally, focusing on pre-seed and seed stage companies that are incorporated in North America and Europe with one of the founding team members linked to the MENA region. Again, if you would like to ask some more, questions about this, reach out to me after the session. And now over to you, Dima.
Right. Right. So, in today's session, which is our first session of the series, we're going to be talking about the role of the angel investor in the startup ecosystem, some of the patterns that we see among successful and failing startups, and how we evaluate the deal flow that comes through. So, the team, the founder, the market size, and how we assess traction at an early stage. Please stop me or like type the questions that you have as we go on, and we'll also have a Q&A section at the end. So before diving into the evaluation part of the presentation, let's review the typical life cycle of a startup. There are three main stages in a startup's life cycle: the pre-seed stage, seed stage, and growth stage. At the pre-seed, the founders are identifying and validating a problem. So they're testing whether the problem is even worth solving. They're exploring and experimenting to try to get to a viable product. This phase is usually either self-funded, some founders raise a small round from family and friends, or through angel investors. As they progress and they're in the market,
Dima,
they have.
you need to move to the next slide. We can only see the agenda slide.
Oh,
Sorry, everyone, for these technical. I don't know what the issue is.
that was not happening before. Reem,
Yes,
can you?
yes. Do you want me to do it?
Yeah, yeah. Because I see the slides. I'm not sure why you're not seeing it. Can you give it a go, please? Yeah. So do you see the life cycle?
Mm, Yes.
Yeah. Okay. So when it comes to the seed stage, that's when founders have some early users. They are proving that there is a demand for this product and there are customers willing to pay for it. This is where we usually see the first institutional investors come in. These could be accelerators, seed funds, early stage VCs, and syndicates or angel groups. So, in the pre seed and seed stage is usually where we see most of the angel investors getting involved. At the growth stage, when the founders have accelerated growth, they have predictable revenue, we see more of the growth capital, the Series A and beyond. This doesn't mean that angels aren't involved. A lot of angels get involved in follow-on funding, but the contribution is usually less than that of VCs, private equity funds, sovereign wealth funds, and so on. A very common question we get is the round size at each stage. I have to say that these vary vastly. It depends on the geography, like the location of the startup, the macroeconomic conditions at the stage that the startup is at, the tech trends. So, for example, in the past couple of years, with everything happening with AI, these numbers changed massively. So these are just ballpark numbers. I'm going to stop here to see if anyone has any questions. Should I move on? Okay. So, what's the core role of the angel investor and their involvement in this journey that I just described? First of all, you're obviously providing the early capital, but more than or beyond that, you're providing the credibility and the strategic support to help the founders move from this very early stage of validation into early traction. So this funding will go into development of the first product or the MVP, early hiring of a team, financing, marketing and customer validation. So you're really helping them achieve the product market fit. We're also reducing the risk, the product risk, the market risk. We're signaling to other investors that they can trust this founder, basically, and help them secure their seed round or their first institutional round. And we see a lot of angels, especially the ones that have relevant industry experience, help founders with customer introductions. Some of them are their first clients. They're willing to test with these startups. They help with hiring, so hiring referrals, and giving basically access to their network, which is very important at an early stage. So attracting and signaling and showing momentum, and a proof of belief in the founder, is also a part of, the advantages of founders securing this first angel round. So as you know, early stage investing is very risky. And the key to better decision making at this stage is for us to recognize the patterns behind the startups that succeed and the startups that fail. Some of the very common causes for success that we see are founders that have a founder market fit. What we mean by founder market fit is the founders that have a very deep understanding of the problem. They have insider knowledge or they have lived experience with this industry that they are targeting. So they have strong conviction that is rooted in insight and they're not just trend chasing or a feeling. Successful founders and successful teams are usually very customer centric. So they're the teams that are spending time with customers, with real customers, interviewing them, taking their feedback, iterating and refining their positioning based on those conversations they're having with customers. And the speed is really important at the early stage because usually the runway is very limited, the resources are very, very limited. So rapid experimentation, teams that can make data-informed decisions are trends or patterns of successful startups. Strong execution discipline. So, what I mean by that are teams that have set priorities and a focus, and they are able to allocate resources for these priorities. They will usually win the race, especially now when it's becoming easier to come up with an MVP and go to market. We're looking for teams with execution discipline. And even if a startup or you're participating, investing in a startup at an early stage, there are some early signs of product market fit that we should look out for. So are there organic referrals? Like have they tested with one customer and that customer referred them to another customer? Are there retention curves? So are they able to have the user come back and use the product more than once beyond the testing stage? That signals product stickiness, which we want. We want renewal and we want to see a willingness to pay, even if they haven't paid yet, but they are willing to take the time to try out the product or the tool. On the other hand, some of the causes of failure are, teams that are overbuilding. They are building internally in isolation of the customer. So they keep avoiding having conversations with real customers. Teams that keep telling you, we're not ready to show it yet, we're not ready to test it yet. That hesitation leads to paralysis and leads to them running out of capital. So that's definitely a red flag. If they are not able to identify a clear customer, so if they are targeting everyone, or if they are not able to word the value proposition, even when they're describing it to you or you're meeting with them, and they're not able to simply describe in one sentence what their value proposition is, that's also not a great sign, even if it changes. And we do expect early stage founders to pivot, but they should be able to describe their value proposition at this stage when they're fundraising. One of the biggest reasons for early stage startups to shut down is actually founder misalignment and fallouts. So if there's tension over equity or they're disagreeing on vision, there's poor communication. These are patterns that we see, but these startups don't usually make it. Slow iteration, like I was saying, speed is very important at this stage. So yeah, that slowness is going to lead to poor burn management, and therefore they will die out basically before being able to have this initial traction that allows them to move on to the next stage. I'm going to pause here for any questions.
Yeah. Hi, Dima. Thanks.
Hi.
So far, very clear. Just a question here. So how do you call out someone who's very good at persuasion? I don't know how to pronounce it in English.
Persuasion, yeah.
Persuasion. Thank you. Versus someone who's really like very solid when it comes to the content of what they're building.
So you mean they're actually building something, you can see an outcome versus they're just being able to, convince you without showing you something?
Yeah, basically, how can you probe this, right? Because some people are
Yeah.
just very good at telling, like storytelling,
Yeah.
at being convincing,
Yeah.
but maybe behind the scenes there's not much substance. So how can you push and probe for this?
Yeah. So getting the customer feedback first, if there's an MVP, something for you to try to see, like a product for you to test, I would always sign up for even if it's a beta test, you should try the product yourself or the service yourself. The second thing is the feedback they're getting from customers. We always ask for feedback, real feedback from real customers. We often actually go out and talk to their customers without them to hear about what they think of the product.
Oh, thanks, very
But
clear.
yeah, I'll get to more details now, actually.
Dima, we
So,
have a question
yeah.
from Evelyn. Do angels sit on the board and in which circumstances?
Yeah, that
Sure.
was in
So,
relation to the previous slide, the core
Yes.
function of the
okay.
angel.
Yeah.
Thanks.
Sorry about
Yeah. So if the angel is a strategic fit, if they have strategic input, if they have relevance and clear, value add that the founder wants and needs, it could be part of the agreement. It's not very common unless they are from the same industry or, there's a strategic outcome from them being on the board.
And usually at the very early stage, companies don't form a board. Usually it happens at a later stage, but they might have like an advisory board at the
Yeah.
early stage.
Yeah.
Ah, cool. Thanks.
Yeah. So how do we mitigate these risks? What are the like key criteria areas that we look at? One of the most important ones is the team, because at an early stage, when there's no product or traction, it's really just the team that you're investing in. An evaluation of the problem, the market, and traction. When it comes to the team, I touched on this previously on the founder market fit. So the deep understanding, the experience that they've had, the insights. So do they have any domain insights that others might have missed or not have seen? Is this the team that is able to actually win? So we now see, hundreds of startups, if not thousands of startups, addressing the same problem, trying to solve for the same problem. So your conviction about the team and them being the team that can win among the competitors is the key thing that we're looking for here. And in terms of problem, we're looking at the severity of the problem. So is this a hair on fire problem? Is it a frequent, expensive, and painful problem? These are the problems that are worth solving. Are customers willing to pay for it? Are they hacking their way now to it and paying for alternatives? That is also a good sign that there is potential here. If there's no competition, that usually means there's no urgency. So this is something we need to look further into. Maybe it's not a problem worth solving for. And in terms of market, we're obviously looking at the market size, but the key thing here is if whether or not this is a product that is capable to become a venture scale outcome. So does this business have the potential to become $100 million business? And is there an opportunity for growth in the market, or is the market stagnant? Are there structural tailwinds? So, are there big external forces that are going to help the startup grow? What I mean by that, are there regulatory shifts that are pushing it forward, or are they going to become barriers? Is there the technical adoption, the behavioral change that is pushing this idea and concept forward or holding it back? And in terms of traction, it really depends on the stage. But at the pre-seed stage, again, we want to look at the user interviews, the user feedback, the early pilots, the feedback on the early pilots. Are there wait lists or letters of intent if it's a B2B business? So those are like the KPIs or the metrics that we can look at, the numbers that we can look at. And at a seed stage, there should be some early revenue where we can assess the unit economics. So, do we have positive unit economics? Are the COGS and OPEX, does the math, can this business make money? Eventually, maybe not at this very early stage they're at, but eventually, will it become a business that is revenue and profit generating? And there are conversion KPIs that we want to look at a seed stage, like if we have users that are testing, if no one is continuing and no one is paying, that's not a good sign, right? So it really depends on the stage in terms of traction, but there are always some numbers that we can look at. Yeah, I dive deeper into each criteria, but maybe I'll stop here for more questions.
Dima, some people want to leave early, so they want you to go through the presentation and then we'll open it up to the questions at the end.
Okay, sure. So zooming in on the founder or the founding team and how we assess the execution risk. So there are some questions that we try to ask the founders to get into their heads and understand their mindset. The Viaka team, for example, meets with the founding team of a startup at least 3 times. And you can participate or attend the Q&A session we have with the founders so that you get to know them better. But some of the things that we always ask them are their unique insights, what they see in long term, so their vision that others might have missed. How they have first encountered the problem or their experience with this problem or in this industry, what they've built so far, what they've achieved so far with the limited resources that they've had, and the milestones that they have set for the short upcoming 6 to 12-month period, let's say. The challenges that they have faced, it's important to see how they respond to challenges. And if they've had some feedback from customers and their approach is being challenged, how do they address that? As well as in a team setting, how do they settle disagreements and how have they divided up the responsibilities among the key team? So yeah, these are the main areas that we try to figure out with the founders. On the market size and demand, so we're looking for large and growing markets with clear signs for customer demand. We obviously do our desk research to estimate the size of the TAM. The TAM is the total addressable market. And we validate the growth plans and the go-to-market strategy. So we should always ask the founders for their go-to-market strategy and their growth plans. And we try to, not fact check that, but kind of check if it is going to evaluate if it will be able to scale across geographies or industries, and if they would be able to gain significant market share. Because we are looking for venture scale outcomes. So we're looking for the 10x to 100x ROI. This is the only way for us to offset our losses from from a portfolio. And we'll talk about portfolio construction in our next session. So we're not just looking for large markets, we're looking for the startups positioning in this market, their ability to gain enough market share to give us this outcome, this large outcome. And lastly, on traction and how we interpret traction at a pre-seed or seed stage, the revenue traction might be still limited, but there are early indications that we look out for. There are KPIs that show us that there's product market fit or there isn't. So some of the clear signals is whether we have customers that are willing to pay for the solution. So from the pilot tests or the beta tests, what's the response been like? Have they been able to convert them to paying or subscribed customers? In terms of usage as well, so doing a cohort analysis and seeing how the customer is interacting with the product, returning to it. Are they referring other people to it? And internally, is the team iterating? Is the team rapidly adapting to this feedback? Are there clear milestones being achieved with the resources that they have? And yeah, just evidence of an increase in progress, even if it's not revenue that we're looking at, but more of the usage and adoption of the product.
Dima,
Yeah,
when we were, because of the tech, sorry to apologize again for everyone. And I don't think that Dima can see the slides also. We were not able to, we zoomed through the slide that has the funding round. So I just want to go back quickly to
yeah,
that um, and just show it, the round sizes.
yeah,
And of course, there are differences. The
yeah,
US, they're usually much larger. And
yeah,
here we listed the UK just for you to have an idea about those ranges as well. So if you can just very quickly note on that slide regarding the round sizes, pre-seed, seed, and then the growth stage. And
yeah,
then we'll
sure.
move to the Q&A.
Yeah. So at the pre-seed stage, it really depends on not just the market that the startup is in, but who they're raising from. So usually within accelerators, for example, or acceleration programs, the ticket has now increased to 250, in some cases $500,000. The numbers are changing really quickly, especially over the past 2, 3 years with the AI wave, and we're seeing much bigger growth stage rounds with private equity getting more involved and sovereign wealth funds. So these are just ballpark numbers. But the concentration of the angel investments is usually within the pre-seed and seed stage. And then it would be a smaller percentage of participation. For example, buying secondaries in Series A and beyond startups, that kind of engagement. But yeah, these change with the macroeconomic impact, the time of the year, even there are seasonal effects. So it's vastly different. But what we've seen over the past year or so, I would say in the US, these are the
These are
uh,
the ranges.
averages, yeah, the ranges.
All right, so we're gonna open it up to questions and answers. You can either like drop it in the chat or you can just unmute yourself. And is it smart for an angel to diversify and go for some Series A early growth deals?
Yeah, definitely. You want to diversify across geographies, verticals, industries, and stages. You want to keep some of your budget for follow-on funding, and that is the funding that goes into the growth stage deals.
How much should like somebody who's interested in becoming an angel, how much should they invest like in a single startup, Dima, if you can?
So I would say we're going to cover that in our next session, but it depends on what your total budget is. So I would start by setting a total budget and then dividing it up, maybe divide it up over 10 different opportunities, in 10 different industries, geographies, and stages.
So when you do the total budget, do you do it for your total investments or per year? Like, do you treat yourself as a fund that will invest over the course of many years, or you say per year I'm going to invest that much?
It really depends on your situation, but keep in mind that these are long-term investments. So these are 10-year deals, right? You're more likely to see the returns skyrocket, hopefully at between year 4 and 7. So it depends on your situation, but you should keep in mind that this is a 10-year commitment.
I mean, the second session we're doing will be about portfolio management. So that would be great. If you can't attend it, we'll share the recording.
Yeah.
Just make sure that you sign up for the session. Is there a correlation between the round sizes to the startup's traction? For example, in order to go after seed, what type of traction would the startup have to reach?
This keeps changing. If I would say 5 or 7 years ago, getting to a million ARR was a seed stage round, or sorry, a Series A round. Now we're seeing if VCs look for ARR, or revenue, annual recurring revenue, earlier, because there's more competition. There is, it depends on the industry as well. So if you're in AI now, no matter what that means, it's acceptable for your round to be bigger at an earlier stage. So it just depends on the industry.
What are the
Um,
requirements or qualifications for someone to become an angel investor with Viaka? Really, no requirement. We definitely you need to be a professional who's interested in angel investing. You want to engage, have some skill sets that you can support with. But definitely, we're open to young professionals as well. So if anyone's interested, please reach out to me. I'm going to drop my email again in the chat and happy to have a one-on-one with you. How can angel investors balance out the early traction signals in hardware semiconductor startup, one that's capital intensive at the beginning? Technology is demanded, but no validation yet.
Um, to be honest, I would talk to other people with experience in this space. This is the positive thing of being part of a syndicate or a group, where we can have the opinions of people from a more relevant background and industry. But it's really about evaluating whether you think long term, after this capital intensive research, like there's a long R&D cycle there. What is the plan? What is their go to market plan? Do they have what it takes to compete with other companies in the space? Why would they be the team that makes it in this industry?
Okay, so we have another question about Viaka. We've made 10 investments. All of them have been the majority based or incorporated in the US, one in Canada, one in London, one out of Dubai, but they're actually selling in the US market. So, I mean, we look at all geographies, but definitely you have to be setting up for global scale. So if you're just focused on one market, it's not of interest for the Viaka Angel Network. Dima, what matters most at the early stage? I mean, you talked about the team, you talked about the market, you talked about traction. What is like the deal breaker here? I mean, the thing that angels need to really, really look at.
Conviction in the team. I know I'm repeating myself, but really it's
Yeah.
at an early stage. It's your conviction that this team has what it takes to make it in the race. Why would they be the ones that will win this race? How is their approach different? What do they know that others haven't figured out? Their advantage over others in the market. I think we have another questions.
Yeah. Um, yeah. So Ahmed is asking if, for example, a dentist or surgeon to focus on just like, for example, medtech or an industry they're familiar with. Definitely, it helps, especially if they're building something and you're in the sector and you have a clear understanding of the problem or the challenge that they're trying to solve. But that doesn't mean that you should not be, looking at other sectors as well.
Yeah.
We have physicians who are part of the network who are investing across the board. And what's nice about Viaka is that when you join, there's no obligation to invest, and you can join the Q&A sessions, the due diligence sessions, and it will be a very interesting learning experience. So you will be exposed. You can connect with other members, learn more about other sectors as well. And at the early stage, you have to like diversify your portfolio across sectors as well. So, and we have a lawyer who's part of Taft Law who handles our legal work. We create an SPV for each company, and all the we create the Viaka SPV where all the investors are part of it, and it sits on the cap table of the startup. I don't know, Dima, if you want to add a little bit more about if somebody is in the medical field investing in other sectors as well.
No, I would, agree with you. It would be interesting to participate in one or two relevant deals to your experience, but you should also diversify. Not all 10 or not your entire portfolio should be medtech or health tech. Um, Samara's question about the co-founders.
Mm.
So we always prefer that there is at least one co-founder, one, two, or three co-founders. It just mitigates the risk if someone wants to leave, something happens to one of the founders. But it's also about the complementary skills. So we want a team that is technical, operational, balances each other out. So that's always preferred. But I wouldn't say it's definitely like it's a red flag. They could bring in more key team members and give them ESOP, like stock option. They could be looking for a co-founder that complements them and down the road find someone that complements them. I wouldn't write it off if it's a solo founder.
I think it also depends on the startup. So if it's tech, it's definitely preferable for the CTO or the chief technical officer to be a co-founder. So that person is fully invested in the business, because if that, and teams split, founders, they split, just like, employees leave. So that happens a lot. But co-founders splitting is much more difficult than just an employee leaving. So if it's a tech startup, it's preferable, to have a person who's, focused on building the tech, and then another person who's running the business, the commercial aspect of it. And down the road, of course, you would want somebody to run the internal
Yeah.
business and the operations of the business as well, because
And
it's
you
not
want
just
to make sure.
yeah,
Sorry, you want to make sure that they own the tech. So you're
yeah.
saying contractors. I don't know if you mean you're outsourcing the tech. If you're a tech company and tech is your core thing, it has to be built and owned in-house. I worry about outsourcing too much, that you don't actually own the IP or have control over the IP. So you don't want to outsource too much of the core business.
Yeah. There's a question about our selection process and how, Angels. Let me maybe just go through how so we get through inbounds, outbounds, the scouts, referrals, through events where we meet founders. Last year, we went through 150, we looked through 150 companies. We start, the companies that we like, we start with an interview. The team interviews the founders. If we feel it's a fit and we feel that they're building something that can scale globally, we're very excited about the team. The team has a member who's either from the MENA region or connected to the MENA region. There are non-Middle Easterners who grew up in Dubai, for example. So there's a connection to the region. If we like the team, we like what they're building, we set up another call and then we invite relevant angel investors to that call to also weigh in. And that call is a 1 hour call where we dive deeper into the business. And as I said, we always co-invest alongside a leading US or a reputable investor, so they've done their due diligence already on that. Now, after that DD session with the angel investors, if it's a go, and then we schedule a session with the wider angel network. And then they get to see the startup or the founder pitch. If they like it, then they can say I want to invest. Depends on the minimum ticket. Usually we run very small tickets, 1,000, 2,000. It's gone up to 5,000 in some cases, but they're usually very minimal tickets. And then, it's like a crowdfunding exercise. Some deals we've invested 25K, others we've invested 250K. So it depends on, how excited the wider network is about that. So this is how we usually run the process. And then the committed angel investors, we send them the legal papers, they sign it, and then we create the SPV, and then that SPV invests in the company.
All right.
Yes, absolutely. There are other ways to get involved with Viaka. Please reach out to me. I would love to connect with you. Sorry, Hani, did you want to say something?
I had a question
Yes.
just regarding Viaka. Just wondering, like, what are the top advantages of, joining Viaka over the other angel investor, clubs out there?
Okay. So we're not just an angel network, we're also a platform. And we have city chapters throughout, the US and in Toronto and in London, where we host in-person events regularly. We have a large also conference, MENA Rising, which we hold it once a year in Toronto, once a year in New York. So we provide online and in-person spaces for people to come together, to connect, to learn. And through these events, we try to like scout for exceptional founders to be able to support them and also meet, professionals or people who are interested to join the Angel Network and support these exceptional founders, not just with a small ticket, but also with, helping them through mentorship support or helping them open doors for them, making introductions. So our network is not just about writing the checks. We go way beyond that. We leverage the entire network to support them with access to, partnerships, markets, learning opportunities, etc. So this is really what we bring to the table. So it's not just angels coming together. It's a much wider network of just people connecting together.
Thank you so much.
Yes, our annual membership fee is $400 for per year with no obligation to invest at all. And then for young professionals who are 26 and younger, the annual membership fee is $100. No success fee. It's not a success fee based. Happy to set up one-on-ones with you as well. So reach out and let me know. Dima, you mentioned that angel investing is a long-term game, you know? So, like from your experience, how long does it usually take to see returns from angel investing?
So the peak is between year 4 and 7. It will be slow the first 1 to 3 years because this is when they're gearing up. You might be able to sell in secondaries, or if they're, so secondaries by, I mean, there's a bigger investor coming to buy your shares. You can see that between year 4, 5, 6, 7. Exits and early acquisitions between year 5 and 7 could also happen in active markets like the US. It's not, uncommon. So the peak is between year 4 and 7. And then, you have a lot of companies that go dormant or die out, and you want to start cleaning up between year 10 and 12. Um, as in exiting from the opportunities that you do not see yourself exiting or getting a return from, because they become a liability.
Yeah. And really, other than the financial returns, just being within the startup space and like being, willing to write even very small checks, keep you updated. Technology is changing so fast, and you just stay updated with what's happening, the trends, what founders are working on, what is gaining traction. So there's a lot of excitement around that as well. Just staying updated.
Definitely.
Any other questions? So you talked about traction also, Dima. Does it make sense to invest in a team at the idea stage, or is it better to start seeing some traction? Do like angels who do you need to know the founding team personally to invest in them at the very early stage? When do you come in as an angel?
So it's now become so easy for you to prototype an idea. Like you can use Riplet, you can use Claude. There's so many tools that you can use to start building an MVP and talking to or testing with different customers. There are online testing tools that you could use. So, I think we should ask for more than just an idea. It's very cheap and fast now to build an MVP. You don't necessarily need to know them personally, but when you do, you kind of understand the background and why they started the company and their experiences, previous experiences. But most active angel investors will invest in people they've never met before.
Yeah. And experience, I mean, there are founders who've, are experienced in like, they're older, they've
Yeah.
worked in, let's say, the corporate world. They've experienced firsthand what the challenge is, and then they're building that solution. So that adds significant credibility to the founder. But most importantly, is not just the ability to build a product, it's the ability to, execute and sell
Yeah.
and build a company and manage a team. So it's not just about the product. You have to assess the whole deal from a holistic point of view. Is this person, managing the team, being able to build the right foundation to scale the business as well? Because so many times we've seen, founders so excited about the product, but they don't know how to sell it.
Yeah.
They don't know how to manage staff as they grow. They don't
Mhm.
create a conducive culture, company culture, and then it's just downhill from there, basically.
We hear the same idea 100 times.
Yeah.
So it's definitely really about the execution and their approach, and their ability building and enabling a team around them that can scale this.
Yeah, and I mean, whenever like I'm chatting with a founder who's just coming up with an idea, they would just want to be hush hush about the idea. I tell them, on the contrary, talk to everyone and their mother about this idea,
Yeah.
because at the end of the day, it's how you execute that will differentiate you. It's
Yeah.
not, sharing an idea and being scared that somebody's going to copy it.
Yeah.
People will copy. What will differentiate a successful startup is the ability to execute,
Yeah.
for sure.
It's actually a red flag if a founder asks you to sign an NDA or is holding back on what they're trying to do.
Yeah.
So yeah, I agree. Thank you, everyone.
Thank you, everyone. This was fun. And we will share the recording with you and look forward to seeing you all in our next sessions.
Thank you. That was a great session.
Thanks a lot.
Thank
Bye.
Thank you, guys.